we're going to take a look at the 2012 bull run that's in full-fledged right up here to the very top of where 2011 was on the Nasdaq 100 that fell, and we were short during this period of time. And we were short that period of time, 2011 period. Now, let's get back over to the 2012 because that's 2011. When you run in the very short-term period, we're about 83%. We're getting to a major top where the bull better, unfortunately, it's a great rally up to there for them. And it's great. But the thing about it is that now the risk is going to increase even more for the bull. Because what you're doing is that 1 week, 2 weeks, 3 weeks right here, you've gone parabolically straight up. And we also know that when I come right into here on this weekly level, and I have this little pattern that you can see right up at where this trend line is, right above the weekly moving averages, this is like a rising wedge. And the thing about it is they need to pull back. Let's take a look at where the potential pullbacks would come. When they come, they will come. And that is the top of the bull run right up here at 24.40. So we do have alarms set up there. So they're not quite there. You're at about 24.18. That means that the weekly buy signal here is in play, but in the shorter term, it's reaching its peak at 83% here. You've got the 200-week moving average down here. These weekly moving averages, you got the 10, you got the bullish 20, and finally, they've came up. We don't have any major crossovers. What I just want to point out, this is another resistance level before you get to that upper top, and we're right there. This is where the bull is going to have a lot of risk and should be extremely careful. Exuberances in short-term moves also will have pullbacks, just like you had exuberance here, but you pulled back to these levels, and you had a couple of week pullback here. This rally here has not had one pullback, none, except for a week ago Friday, they bounced it off the bottom. So the bull sentiment is changing bull, and they're trying to get back to even from last year's reversals and putting in the bottom and that the world and everything is peachy keen. No, it's not. Ben Bernanke's injecting money. QE3's around the corner. Rest of them are piling in more money because of, hey, the world's in dire straits. That's the truth. But right now, what we have is a short cover squeeze. We're going parabolically up, gap after gap. That's how shorts come out of the market. They started the gap here, they continued it, and they continued it. So when we were closing here, we were down here up to 2250. And we ran in Nasdaq 100 points. And that period of time where that gap was, even the low end of that gap is you're well over 100 points higher. There will be at some point a pullback to areas of at least 23.25, 23.10 would be the lower end, and then you'll have some pit stops around 23.50. Now, having said that, when we go over to all of the Nasdaq 100 calls, and I'm going to show what some of those are, I'll find them here in a moment. That's the wrong one, but here it is right up there. That's that bull run to that top. But let me tell you, when we go through all of our calls, we're going to look to see where the weekly call beyond extreme. So let's take a look for February 2250 call. They're about as high to the ceiling as you can get, meaning that these contracts were back over here at $80. They gapped them to 110, to 150, now to 174. That's a 2250 call that's bloated up in the money. Sorry, I've never seen one stay up here. Now, when we start looking at other strike prices in February, such as this 2350 call, which is well above part of this whole gap, here it is. It's getting right up at the very high. Here's what happens when they do get inflated. They come down from 30 to 88. We're in that zone where people better be careful because they're only going to go so high and then they're going to drop in value. That's the 2350 for February. So what we look at for February is we take a look at the $2,400 call that was down here on a gap on the low. I mean, this number was down around $24 or $15.60 last week, or back in this time frame on 12/18. But look at where they've marked them up. You can tell right here that they have marked them up considerably. And what they've done is we're going to test this area on the upside. Now, granted, you can't have a one-way bear, and you can't have a one-way bull, and you can't have a one-way inflated market. It just doesn't happen that way. And hey, once the exuberance and everyone chasing and whatnot, the call side here, even up the $2,400 call, is way up there. But now if I go to February and flip right over here on this end, this put option, on the other hand, that was at $200, now down here to 48. You can see that these are getting very deflated, and we'll be monitoring these lows moving forward. This is going to be the contract of the 2400 February in a very short term, that when we do get the reversal, will leverage itself back up to at least this area of $80. When the overbought and oversold or inflated and deflated side of markets readjust themselves. Now, the ones that we had covered up and out of the money was this one here. And you could take a look at the 2450 call that was down here at the $15 level, which is a great hedge. They too have entered or are entering right back up here where these gap downs were, and that's up and out of the money. So you can see where most of the market at 2300, if we were to pull back, you're way up here. This is a disaster. People that own these and got lucky, if they ever did, hardly anyone trades them because they don't know how to. But the thing about it is, that's a complete wreck. This thing here, you don't see this kind of stuff happen very often. And you don't see, because they started the gap from 60 to 80 to 100, over 100, and now another $32 from there to there, all done on gaps. All done on gaps. And this contract all the way up, and I have no more to say. That means this comes down in value because it's inflated. It's a time series. It will take time. You're only going to be able to get so overbought, and you're only going to be able to get so overbought and so imbalanced. Just like we used to talk about the bear all the time. Bear is going to get all the way up there when the puts used to be just like this. The puts were always way up here. And they got marked down. But then the same way, there will be adjustments. There will be corrections in here, and we will be on it at the right time. I'm featuring the Nasdaq 100 bull move, but I'm also saying in the short term, it's running too fast and too far on the Nasdaq 100 in the shorter term. It's a bull move, great. But the problem is, people beware that you're at major tops, and they're going to have to break the upper top of this trend line. Right up here is going to be the ceiling. And at that time, the other side of the market will be at the ceiling. The whole call side of the Nasdaq 100 will be at the ceiling. And that means that we'll finally get the damn bottom of the put side. That's where transactions, offsets, and things like that in short term can be done. But we remain on the sideline until we find out when we're going to get our reversals. You got a bull weekly chart. You got a bull run. Wonderful. But I'm sorry, bull runs get overbought. Beware.